We are now.
Yes, we are. Okay, perfect. All right, good evening, everyone. Justin Scott here from 876 once again with my colleague, Nicholas Dundas. All right, yes, sir.
Mhm.
And we're here tonight to present you our Q&A session with our special guest, Mr. Ryan Strachan, who just jumped out at the moment, but will be back quite shortly. And so, a quick little rundown of what we'll be doing tonight is we'll be going through some of the questions that you, the viewers, current investors, future investors would have had and that you'd like to ask of us, right? So, Mr. Strachan is here again. So, yes, sir.
Yeah,
All right.
right
So,
on.
yeah. So, end of a very interesting year to say the least. The markets have done what the markets do. Valleys
Yes,
and
sir.
peaks, valleys and peaks. Right. So, without any further ado, I imagine, yeah, let's see what the questions are. All right. So,
Let's start. Who's gonna begin?
right. Let me just check on the I was supposed to there we go. What are the key steps to building an investment nest egg for a comfortable retirement outside of a pension? Okay.
So you start off with like a hard one first, right? So
Yeah.
firstly, it's good to connect with you guys again. Thank you. I think so. I want to like take a step back, right? So I think the assumption is that a pension can provide you with a comfortable retirement, which I think is in Jamaican dollar terms, if you go through history, probably isn't accurate. I think when you think about the rate of devaluation over the last, I don't know, 40 years, that would be 1980. I'm old enough to remember a time when the dollar was, I think, 8 to 1. That would have been 1990, 91. Funny story, I was actually in the dentist's office with my mother. She was taking me. And I remember I had some US. I don't know if I'd gone away this summer. And I was like, how much can I get for this in $J? And it was, oh, you can get $8 for it. And I was like, well, a few weeks ago it was 6. So what on earth happened? It's been 91. Couldn't have been much later than that. Anyway, long story short, you can imagine from 29 years ago to about 143 something as of today, the pensioner who would have earned based on a salary, Jamaican dollar salary, working for 40 years would be disadvantaged. No. So I obviously advocate for pensions. So I think many times people think when you point out the reality of something that you're against it, it's not so. It's just the reality, just the reality. However, so I say it again, I am in favor of pension. I think though what's important is to manage the pace of asset acquisition, or rather to manage the pace at which one deploys their lump sums of cash. Because I've seen people 15 years ago. So I mean, like in my case, I'm 38. So I'm seeing people 15 years ago have a lump sum and they buy an asset of whatever kind. And for all intents and purposes, we're not going to put a car in this asset we were speaking about. So they buy a house or whatever, and they take the bulk of their savings and they buy one asset. Now, over time, one may ask that how did that asset class perform relative to a diversified asset class? I guess what I'm saying is people who bought stocks 15 years ago, chances are much better off than well, I know for a fact they're better off than anybody who bought any other asset class. And this is the right stock, by the way, or diversified portfolio. So the short answer, the key step is to diversify. Many times, because our parents who are not financial advisors will tell us you need to buy a house first. And they will say, well, if essentially what they're saying, lock up 90% of your net worth house, your first house, and then try and work hard, and then so you can buy another house. So then you have 80% of your net worth, well, 85% of your net worth two houses, but then you're like 45, and then you're top of the food chain in a company, and then one day you get laid off. And you need cash in a jiffy when it could be harder to get a job as a result of being a senior. The question is that really the best approach? I think diversification, where you break up your holdings into quadrants as best as possible. You want to have maybe four. Your quadrant, four, and real estate, your cash, your stock, and other fixed income. Or you can actually be a little bit more flexible with that fourth bit. But it's important to see, because you don't want, like, as I'm progressing through the stages of life, I'm seeing where a lot of people who had like fancy homes in their 40s are getting to 60, 70 now and be looking to sell the house because they can't sustain the lifestyle and they can't maintain the house. Right? So then, they have this wonderful house in all these communities, but because they're not able to maintain it, and perhaps they don't have, successful children or whatever, they're all of a sudden faced with the reality of having to sell the house to probably downgrade or downsize. Nothing wrong with that, but the value they be getting is not the same. So the key thing is diversification. You need to have cash as best as possible. You need to have stuff like life insurance, whatever. You need to have stocks and liquid holdings. You need to have bonds. But 95% of people are not diversified properly because they place a house here, and then everything else is below it. And I don't necessarily think it's the best approach. House is very important, and I hate to tell people all the time, I love real estate, but that would not be the be all and end all. I've made the example on Twitter already. People who had $1 million paid on in a house 10 years ago, who bought NCB, would now have 10 million now, right? On top of dividends in that time. Now you will say to yourself, okay, we love the benefits in the future, right? But let's just work it through. The payments one would have to properly assess. And you guys are analysts, you can do it. What would the difference between the payments be over that period of time if you put in 1 versus 5 or 1 versus 4? Because if you only have 1, so you put that 1 in, you're starting from 0 again. You put in 5 now, you're starting from 5. And in US dollar terms, most properties have not kept pace over time. Countless examples of that. So everything has its place. That's the story. That's the way I put it.
Right. Yeah, I think you touched on a very key, step right there, which is the importance of diversification. Whether it be, it's very important to have, your home, or to ensure that you're set up properly. But then you also want to ensure that you have some assets which can be liquidated in the event of emergency easily, unlike housing or real estate and so forth. At my age, I can't say that I've thought about retirement for more than like 5 minutes at a time.
I don't ever think about retirement.
But I do understand the importance of pensions. I have pensioner families, I have pensioner family friends. So, and I have pension funds buying the stuff that I buy. So I definitely understand the importance. Although what I can say from my experience is it's good to know the cash flow, how much I earn, how much I actually spending, and then to always put aside some of that. But they want to do it in a savings fund, where they want to do it in credit union, because folks can get good rates for that when you're taking loans out against it, or for whatever reason. Or you could do like I do and have stocks. And personally, what I do is I have my core portfolio, which that I do my trades on, and then I have my long-term portfolio, where every time I get paid, there's a set amount that I take out of that and just invest that into the stocks that I believe will provide the most value for me going forward. So there are some stocks that I say, all right, cool, this will have this one return within the next 6 months, year, 2 years, versus the ones that I say, all right, this at this price right now, you will never see this again 2-3 years down the line. And so I'm actually actively investing in that. Dollar cost averaging, meaning every month get the paycheck, buy it like this. I could, sit down and wait until it reach my price, or I just buy it when it's there because I know that value.
Oh, fair, fair.
The one small thing to add, I mean, Ryan really did touch on what's probably the most important thing. In the same light, I think that asset allocation is the most important thing. When you are trying to build for the future, what you need to do is sit down and make an actual plan, pen to paper. Understand that, all right, maybe in things change, obviously, and your wants will change, but if you can say to yourself that at this age, I want to have this kind of lifestyle, and you can put pen to paper to see how much you need to be spending per month, per year for that kind of lifestyle, and then you do your
Mm.
asset allocation based on those kind of needs and wants. So you will be able to look, as the example he said about the having the houses first and then you need cash flow afterwards. You'll be able to see that okay, at 60 years old, you still want to be able to buy a grandkid something for the graduation or whatever. So you know you need to have cash flow. So at that point, you can already decide that hey, I need to allocate 15% towards um, a bond that has regular coupon payments or whatever it is. So you
Mm.
plan ahead, actually put pen to paper. I mean, obviously, I'm not planning for pension right now or retirement. I mean,
Same.
but in the same way you allocate a portfolio to think about next year you want to spend this portfolio money on carnival. The same way
Mm.
10, 10, 20, 30 years from now, you can plan to say, hey, I want to have certain amount of cash flow.
Agreed.
So in the
Agreed.
same way, you have to do your asset allocation to ensure that whatever asset classes you own and are weighted in whatever percentages can provide the lifestyle that you want when you're retired.
Yeah,
And I
man.
mean, the truth is, like, I don't even think that far. I mean, the reality is, if you invest well enough over, a 2, 3, 4 year period, pretty much at that point, you may find almost fruitless, relatively speaking, to your portfolio could grow to the point where, like, what you earn from your day job is like just pocket money or whatever. Because, I've seen that in few instances, to put it mildly. So I say, I think the plan is noble, and I would say definitely pursue that. But also remember that you can also end up with rich people problems, and I've seen people end up in these situations and blow it. So it's always good to ensure that you have your principles, which is why I endorse your document and everything. But just know that you could have a portfolio position that doesn't close. And I mean, there's countless examples, but there's even like Jamaica Stock Exchange. Yeah, people who put $100,000 J in it 1 year, come back within a year, and it's a million. And this is the majority of the money they had. And then at the time, that was a million then. Now it's probably a couple more million now. Start from 100,000. Now, the question you would have to ask is how long that person take to accumulate that 100,000. Now, all of a sudden, they have 10, 20, 30, 40 times that. And it's from a listed security on the Jamaica Stock Exchange. So that's the other side of financial advice that people don't walk others through, because it may seem like another world. But just like how you can have a COVID where you need to sell a property, and all of a sudden you're having issues with it, and you put your life and your heart, your blood, sweat, and tears behind acquiring it and maintaining it. Same way, you can have the good fortune cascade also. So one thing I'm certain of is history has shown that stock market investing over 10, 15 years is unbeatable.
Yeah, man. All right. I think that's pretty. Here we go. I like this one. I like this one. Is there a proven way to success? Okay. I think my friend Monique actually asked this one. All right. I will say that success is one always out there, but the proven way to success for each person is all trial and error. Like there's no way around it. Because what worked for Nicholas may not work for me. What may work for Ryan may not be the best for me. So it's kind of tricky. You have to actually be willing to take that time out to say, okay, let me try and do this. Have the goal out in step in mind, document the journey along to the path of the goal, or whatever time frame that is. So even if the goal doesn't work out the way you're looking for, then at the point where you say, okay, I should have reached this goal by now. How much did I miss it by? Or how much did I make it by? Or how much did I exceed it by? And at that point, you can just take time tweaking the plan over and over until you find something that works out backward.
I think the proven way to success is hard work and discipline. Anybody you can think of that's successful, it's highly likely that they are a hardworking person and have discipline. And it doesn't mean have to be in the finance world, corporate world, whatever. The first thing that comes to my mind is Cristiano Ronaldo, the GOAT. People, you can look at his salary and be like, yo, some people will work for a lifetime and make the amount of money he makes in a week or a month. It's crazy. But if you really look at how hard this man really works to master his craft, like it's no shocker at all. And the same kind of thing applies for anything that you do. The best artists, ask them about how long they spend in the studios. The best investors, ask them how long they've been taking the history of trends and doing the analysis. You know, you just have to put in the hard work and be disciplined. That's it.
15 hours, no joke.
Act a successful person. That's my submission.
Okay. All right. Oh, they put a date on this actually. Yeah.
I mean, I think one of the things we could expect to see is, or one could check is the US dollar inflows versus target. So we're already starting to see, well, remittances are ahead of where they were last year, I believe. So
30% year over year.
the year by year, right? How much?
About 30% year over year. 30.
A good lick. So already that's a big sign, I would say. I think they of course have to consider if the businesses that didn't pay dividends for all this time, to the above 1%, above 1%, which is cute, which is interesting, is the bank. It's really the banks, right? I think ultimately, to what extent will the backlog or the what's the word I'm looking for, the compensation for the payments missed, so where they bunch up all the payments missed and pay them out. What impact would that have on the US dollar flows? Because the truth is, all these payments are going to overseas sources in many of those instances. So it's going to be US dollar inflows. That'll be the only thing, because it was halted for that very reason. If those payments were being made to J dollar investors locally, the bulk of it wouldn't have been stopped at all.
Don't know,
Who's this one?
don't know if you want to take this one.
I'll just give an example. Um, so, all right, again, I'm speaking from my personal experience and all. So, I'm just gonna give an example. When I entered the QW, I entered an IPO and at a certain price, and things happened. There was a reduction in price, and I was advised to hold the stock because stocks are long term. And I was advised to hold the stock for 3 to 4 years, in the hope of realizing about 15% on that investment. So um, I'm just gonna say no.
Eight.
I personally rather the shorter term than the super long term, because I can. I mean, I think that I'm capable, based on the current environment, I'm capable of getting a better return in the short term um, than I would if I was putting things on for the long term, because stocks are not linear. Things will go up and they will go down. And an example I can give of the opposite side where I actually did it properly was Tesla. I rode the wave of Tesla. Tesla is up and down, up to the top, jump out, it falls by 30%, you jump back in. Not, I mean, it's not easy to do, but I think that's a pretty, I don't want to say it's a quick way to build a capital base, because I don't want you guys to think that. But there is a lot of a lot of merit in understanding how to capitalize on short-term opportunities. And for me personally, I think especially since the fact of the matter is stocks are not linear, and for me, opportunity cost is very important. I I think that short-term opportunities should be taken to build a capital. But I mean, in the same way, um, even though you're doing the short-term trades, you should probably put aside some for your, longer-term positions and all. Don't just throw everything into a quick flip. That is a recipe for trouble.
Yeah.
Right.
Um,
Yeah.
I would say it will depend on how much time you're willing to devote to studying the market, like, because I started investing in 2018. At the time, I was pretty much just December 2018. I was pretty much buying blindly, and it wasn't until I found one that got me like 30% in like a week. This was all by chance. I was like, "Yo, what just happened here?" Like, it was really interesting to me. So I went out there and I found more people who could teach me about stocks, who I could have more conversations with about, who could teach me like look through reports, how to find information, how to analyze what goes on and trends and so forth. And then that got me some more clarity into what exactly was going on, into what are the factors that allow for this to happen, what are the signs that I would have been looking for to say, okay, yeah, man, the money done already. And then eventually I started to eventually stocks and finance just became a daily. Like, if you look through me and Nicholas chats, it's like all finance, all stocks, all the time. So to the point where I'm seeing opportunities rapidly, and then I'm just deciding what I want. But that doesn't mean I don't have long-term holds, because I've been holding some stocks for example, personally, sometimes I hold some stocks for days, sometimes I hold some stocks for hours. Sometimes I hold stocks for weeks and months. Sometimes I buy it and then I just say, no, I want to take this and put it into a better opportunity and then reinvest it. So it all depends, right? So for example, short-term investing for me has been lucrative. I've made enough to keep myself floating even after Corona hit in March, and I had nothing to do but invest and just research and be on YouTube. But now, personally, I'm working and I don't always have that same time to have to be stalking the market like that. So it all depends. So I kind of shifted my style away from day trades and week trades to some holding companies that I believe will bring me benefit by what my time frame is, I would say.
I'm not in my 20s, so I really can't comment.
Once a pass.
Go back 10 years time, maybe.
Uh,
I think this is mine. I mean, ideally, you want to identify 3, 4, 5 businesses, but as your portfolio, as your capital base grows, you're going to find the need to pursue what's the word, new industries. So, for instance, I'll always like manufacturing. I'll always like food manufacturing. I think finance has a place in every portfolio. And I love tech and I love logistics. So I'll always have a place for those in my head also, because I think those form a critical part of the Sahoma human experience in general, right? So, and then I'll start with industry leaders. So I'll buy the biggest bank. I'll buy the 2 biggest food manufacturers, especially if they export. I'll buy a mail pack, which is in logistics. And then, I mean, if it's like marketing, for instance, or advertising or just communications, I think I'll buy the best in that space. So a few other tidbit is the more, I can't find the word, the less, solid is not the word I'm looking for, so I don't really want to misrepresent the thoughts. The less established the industry is, or the newer the industry, right? If you're closer to the top of the food chain, I'll go to invest. So people may say advertising is a transient industry. I don't agree with that. But let's just for argument's sake that would factor into the rate I would look to buy it. Then I'm buying the absolute best business in the space and I'm not diversifying outside of that. But in food, we all have to eat to survive. So I could buy the top four food manufacturers. You know what I mean? Like if it's a bank or insurance company, I could buy three because at the end of the day, we'll always have to use banks for the time being. I mean, it could always change and banks and techs could overlap through fintech, but for all intents and purposes, both of them will coexist. And we have tech also. So, US stock market example, when I was buying, I only buy Facebook. I mean, whenever I'm buying Facebook, Google, Microsoft, Apple, right? Then recently we started to add Amazon to our holdings, and then we added Dropbox because they all have their space in the respective industry. But the three of us and whoever else is watching can be clients of all of these businesses and not be particularly bothered, right? Not overlap or not be like, you take up a space in the cloud or whatever. You know what I mean? So that kind of thing allows for diversification, but I don't diversify for the sake of. I try to ensure my bases are covered. So like tourism, I didn't have when the apocalypse with COVID came, I don't have any tourism driven holding. And if I did, chances are I would be trading the opportunity depending on how high the price went. Because that's not a solid enough industry, in my view. And this is not an indictment on it at all. I'm just speaking generally. It's not a solid enough industry for me to put a pot in the fire and say I'm going to leave it for 10 years. Because you can have a plane crash or a terrorist attack and it's an issue. But regardless of that, we still have to go eat. You know what I mean? So then I'll be like, well, I'll buy the food guys. But that's my personality as an investor. Other people will differ. So to answer the question, having given the background, I think if we get to, I try to do 20%. I am overweight right now, but we will get back to about 20% or so for every business I hold. I'm overweight in two, I should add. I'm not telling the two.
Okay. Oh, all right.
Okay, I mean, I can start with this one.
Uh,
Starting from the same thing that I was just saying. Um, with the same company I spoke about earlier, I am not against. I said opportunity cost is very important to me. Opportunity cost is the cost of the next best alternative. So if scenario A means if scenario A has me waiting a year to recoup a 30% loss, well, unrealized loss, versus scenario B, me taking the 30% loss right now and then having the year to earn back 30% plus more, then, well, whatever amount that into the same principal is, then I'm going to choose a scenario that can get me to the end goal in the fastest time. Generally, it is the case that you can recoup your invest. I mean, in my experience, I have been able to recoup my losses in a way faster time than I would have if I had to sell. The same company that I won't name, they still haven't recovered to IPO prices, even though they're probably
trading well below
50%
now.
50% below their IPO price.
Yeah.
And obviously I've made more than 50% on what I've done in the time. So
Mhm.
I think that opportunity cost is very important. And if you realize that there's a better opportunity, cut your losses. If there's better opportunity, then just move to the better.
All right. Personally, it all depends to me on my particular reason for choosing this company, right? So, say for example, I'm looking for a trade and I set up my risk to reward ratio, which is how much I'm willing to absorb versus how much I'm looking to gain from it, right? Versus, say for instance, now I want something that has a longer time frame, that's really promising, that has a lot of growth. So, for example, I'm in I can tell you, yeah. I'm in C and Square as well. This is over at NYC. And even if there happens to be a red day or a drawdown at the moment, and it would be exceeding my usual risk reward for a simple trade, those I have those I'm a lot more bullish about. So I'm willing to take a little bit of a drawdown for the potential returns that I'm looking for that, right? So and that cannot be just a matter of when you choose to enter the stock. So say for example now you're really interested in it, you really want it. It's, yes, today is the day that I want to buy, and it just happens to be at the height of the day. And then perhaps piece of news comes about, perhaps the bulls just run out of steam and it's time to talk. Or perhaps some people just simply taking profits, right? That happens all the time. So you have to be understanding, and you have to be aware of what you're going for. It all depends. It all depends.
I'm going to jump back in one quick thing. It is okay to be wrong. It's
It's
okay
very
to
much.
realize that you made a wrong decision,
Yeah.
and time won't always make it better. If you make a bad investment, you can realize it's a bad investment. Don't hold on to it just, I mean,
Just
all right,
because.
I will hold on to it just because, oh, I don't want to sell stocks at losses. If you know you're wrong, accept that you're wrong, make another decision.
Yeah, you can't fall in love with it, and you have to own up the mistake, right? You have to literally look at yourself and say, all right, maybe at this time it might have been a lot of emotions where I choose to enter at this point in time. So, for example, yeah, it could all just be a matter of emotions, and you have to look onto it and say, what was the real reason that I bought into this? What is the position I'm in right now? And what is the best course of action that I'll be most comfortable with in making that decision, right? Yeah. What's next?
I mean, I'll just add, I'm not opposed to restructuring, but my whole thing is I try to buy into businesses. I don't view it as the stock or the price. So I think that ties with what you said, Justin. I literally look at it like I'm owning the business. So I've always wanted to be a business owner growing up, and I had one idea, it never sparked, and then I got into this business, and whatever, whatever. So this I'll be a lifer in this industry, however that looks like. But my thing was being an investor allows me to own multiple entities. So I'm not bothered by a falling share price or whatever, because the minute I, I cut the check and I send it to the broker or take out money on my margin or whatever, it's gone. Like it doesn't even cross my mind anymore as being, oh well, losing, or oh well, because I still own the business. So if I see 100 people in a room with an iPhone, I don't really care if Apple falls 25%. But they're not going to dash your iPhone if it fell 25%. So I kind of try to be guided by principles like that more so than stock price movement. Because here's the reality: I could miss the stock charts for a day. When I was younger in the business, and hasn't been that long, but when I was younger in the business, I never had a J trader. In fact, I still even use J trader. So I don't have the luxury of buying, selling, swapping, which is not to say if I think a position has underperformed, then I won't cut it. I'll cut it if I think the company is probably not worth having to that extent. But it's rare that I do that because I buy into businesses that I really want to buy, which ties up with a question that was asked previously, the second half. I really just want to make sure I answer to the best of my ability. It was asked like, what portion of my money do I allocate? So all of it, like, I mean, I don't, I'm very straightforward where that's concerned because, listen, I mean, we haven't had a major buyout in recent times, but I'll never forget. I remember when Red Stripe got
Yes.
bought out. We
Yes.
had I bought it for clients, and literally, Red Stripe language at $4 for at least 2 years, 3 years, and you can imagine people saying, "Well, why you hold it so long? Cut it and buy something else." Right? But this is the bare. company that is like you see you don't see the glass bottles because people picking them up, but literally everywhere you went, you be seeing restaurant. One day there's an announcement that comes. Heineken is buying 25 US cents a share. $4 probably the year before, 32 within 18 months. Right? So, my thing is I could never work hard enough to generate that kind of return. And if I do, then they tax me, right? So either way, I'm not making as much as I would had that money been in a stock that does particularly well and a business that I like and I'm comfortable holding until I have grandchildren. So the premise for me is buy good businesses. If you need to do whatever because there's a better business, then fine. But it's not a thing of, oh, the market's here today, down tomorrow, here right now, there in a few hours, which is that's fine. But the wealthiest guys that I know locally and the ones I read about have bought and held. And as I said to you, Warren Buffett cut his airplane stocks this year. So it's not to say that you never sell. I'm never saying that. I'm just saying you buy after careful selection. And then if you need to sell, you sell. Nobody's saying not to sell, but it's not just, oh, Chuck, we tried this for a few months. I mean, the only people I know who've done business with me for the most part who've lost any money are those who sold too fast.
Mm-hmm. Mm-hmm. Okay. How do you approach an efficient market like the USA?
Plugging in my battery. That's for me?
I mean, yeah, why not?
No, you guys second. Hold on.
All right. How to approach an efficient market like the USA?
Okay.
I'm personally fairly new to the US markets, so there's been a lot of trial and error and learning. It's been a whole lot of learning process. It's a very steep learning curve, I would say, especially compared to the JSC, which is so tame, with our 15% circuit breakers and so forth. So it was a little bit different. For example, getting up one day and seeing stocks like shoot up 200-300% in an hour or so. Like I saw that the other day with E.A.R.S. They were doing some cancer research and they had some breakthrough in regards to a form of stomach cancer. Right? They got some approval, went into this stage, and then the market just went crazy. Right, a whole lot of bio. So, but you wouldn't have known that unless you would have been actively known about the company, researching about it, and would have been prepared, especially after it already had that massive jump to decide, okay, do I want to get in now? Is it too late? Is it just a fad or whatever, So it's interesting. You have to be very firm in your resolve in what you want to go into, I'd say. So, for example, March is a perfect example. When Corona just hit, and then the market took a tumble, like a deep dip. A lot of people, for that to happen, a lot of people that had to sell out. Whether it be they got a margin call, whether it be they just decide, no, it passed my stop loss, it's past the point that I'm comfortable holding, and then they jumped out, or perhaps they just wanted liquidity. That is the point where you decide, if you have the capital available to say, oh, I'm going to buy into this now. These companies are so cheap. I really appreciate these companies. I have the money to that I can spare. It's not going to, affect my life if I invest this. And then I know what it's really and truly worth. Right? And then now, say for example, you can always be forward thinking. Imagine the person would have invested in Zoom from March. You say, well, everywhere's in lockdown, everybody's working from home. What's the dominant or what's the market leader, in online web communications? Zoom. Right? If you had consciously had the thought or would have, taken notice and went into it, then you'd have been handsomely rewarded.
All right, so how to deal with an efficient market? So with it being an efficient market, that means that generally the pricing, they mean the market in general, pricing information very quick. So what you need to do is be on the same level or at least as close as possible with that. The more information you know, the better. Um, I'll end with what the actual advice is. It's the most simple thing, but what's important to do, all the information when you start, when I start my day, I look at the Bloomberg Open and CNN sends me emails and Red was it? Robin Hood sends me emails and I try to read a lot of things in the morning, see what's going on. As Justin said, be very forward thinking. I think that there's so many opportunities in the US in these efficient markets. It's crazy. As he spoke about the Zoom example, I have been heavily weighted in energies for the last month or so, because I mean Biden is I read through his information. I read through what he plans to do for energy in his reign, whatever, when he's in power. So I took some positions into things that I know he planned on doing in the time. And for example, Jinko Solar, which is the biggest solar energy provider in the world, they have given me 40% twice in the last month or so. So I mean, that kind of thing where you find out where the information is and then just act as quickly as you can is probably the best way to approach the US market, the efficient markets. And then the actual advice is buy the dip. It's
My
literally, it's literally that simple. Like when you're playing the game that the US market is playing, just look at what the trends are. What happens is, generally people are not really, they're not feeling secure about the whole corona situation. So you have a game that market is now playing is sticking. So they enter into certain industries and they take profits and rotate to other industries. Once you see that it's happening, play the game with Wall Street and then you should buy the dip when things are falling, you buy them up and sometimes within the same day, most times within the same day, but probably a week, two afterwards, you find that you're in much better position than before. Something that I've been trying to employ a lot for the last couple of weeks. But again, the information is very important. You have to know what's going on. Oh, one more thing let me add. Since I'm talking about good examples, let's talk about bad example as well. I had a short position in Boeing in the peak of Corona. I mean, top flights, so not Boeing. Go on. But there was a point in time where they halted Boeing stock because they were closing a factory. And I was too slow to that information. So what had happened was within probably 15 minutes, a short position that I was up about 10% in reverse, and I was down about 20, I think it was like between 26 and 30%. And that happened in a matter of minutes. Why was I still not position? Because I was too slow to think. So it's understand that things happen very quickly, and as a result, you need to be on top of the information.
As a matter of fact, you need to be ahead of the curve.
Yeah.
I
Uh,
mean, I guess I'll add. I think markets are markets. I think Jamaica Stock Exchange rational. I think rationality comes into play when you're talking about sizable sums, and you still have to exercise the same principle. The same principles I use to make clients whatever percent they make on the U.S. market. The same principle I use investing in Jamaica. The only difference is that I started investing in Jamaica for clients a year before, 2 years before I really started in the U.S. And but we still do the same analysis, we still do the same forecasting, and we still use the same instincts. The truth is, we still guess. Nobody can tell the future. But you want to at least be able to substantiate your decision if somebody asks you. So you need to do the work for sure. But I've guys with like 10 letters behind the name in New York telling people on Bloomberg that Nike was going to be a bust and Adidas was gone. That time I think Nike was like $90 or something. it was split the equivalent of 45, or whatever the number was. Nike floundered for a year and a half. I'm still seeing LeBron James and Kobe Bryant on TV at the time. Nike's won 40 something now, triple. You may tell that guy that, that he's not worth his job and that I'm a good fortune teller. No, it's just the same information. And yeah, you can short trade and all that, and that's very important because developed markets do facilitate that. At some point your portfolio is going to grow big enough where it's going to be hard to do that.
Mm-hmm.
You can do that with 50,000 or maybe even 500 grand. Hard to do that with 50 million. You get to 50 million through ownership. You don't get there through swapping.
Right.
So my thing is, I advise, I'm trying to make clients rich or richer. That's my whole objective. That's it.
Yeah.
Okay, well, I use the Ameritrade for my
That's
US
cool.
portfolio. It's a simple process. Just apply, just call their customer service and they'll walk you through it. And I trade through a platform called Intelligence. I use it for monitoring the stock quotes, charts, doing technical analysis. That's what I do.
Yeah. I use TD Ameritrade as well.
Oh, and I use Cash App as well.
Yeah. There are
Yeah,
other
those are
brokers
it.
out there, but up to your preference. I can only speak on my experience.
Yeah, nothing to add there.
Okay.
I got that question. It's actually a great question. It was two, and they were relatively, I won't say early. The first one definitely was NC. Well, I won't even say NC. Berger, when we were buying Berger when oil prices collapsed, I'm buying it for myself now. This is oh $1.80, $2, $3, whatever. And just adding bit by bit. I actually had a lot going on in my life at the time, but just buying and buying and buying and flew at the same time we're buying like NCB in the 30s and buying a little bit more expensive, but it's buying bit by bit what we could afford. And I think that we're buying Supreme Ventures are like $2.40 and $2.70 and $3. So I look at 2015 when that changed my life because we're buying at that price then. So Berger at 20, 4 years later. So NCB at 200. And I saw SVL at 11. I thought the value, obviously, it's gone higher since. And that's how life is. But nobody's going to say, oh, I want to make 300%. So, yeah, I think that would have been where I think my life changed. Because at that point, I realized, and it's all down to Donovan. I mean, there's no denying. And, he was really instrumental, though I was investing already. But that really was life changing. And that's a play. That's a play. Big up NCB, Berger, and SVL. What do I need to have before I can call Ryan Strachan for financial advice? His phone number. So it requires, right? Well, we're the best. But the I think entry point's like what, 10 grand, I think. But message me, we can talk. I think actually this person did message me. I need to respond. Yeah, I'll respond to it, or no, I think we have a few, no? We have the Sagicor Select funds. Are those are index funds?
Yeah.
Yeah, so we'll have some. Yeah, we'll have some already.
Probably just not in the same concept that they're looking for from other markets.
Yeah, but that's more or less it mirrors it. I think that's for you guys, this one.
What did you read to get into investing? Um, Technically, to be very, very honest, I think it was the Candlestick Bible. That was the very first piece of financial trading type books, right? That was because the very first thing I read about investing was Forex, and I was doing my due diligence. So I did the Candlestick Bible, um, baby pips, whatever, and then gradually I went over into stocks as well because that's what my friends were doing. And yeah, it was after I started investing that to decide, okay, there's a lot more to this, So naturally I read things like the Robert Kiyosaki classics, right? Richest Man in Babylon and things like that. Yeah,
Oh man,
he's trying to say
buy
this.
buy the best stocks ever. That's what I
Buy and
do.
believe,
Huh?
buy and believe.
Yeah, that's it. The two B's. Nothing more than that. That's enough.
20%
Buy
chance
good businesses. Oh, that's. Oh, sorry.
to redeem maximum yields.
Marketing
Um,
is that's
well, I would say don't throw everything into one Hail Mary stock. I would say take a nice little split, find what. Hmm, that's it.
Simple answer for me. I just buy stocks. I don't.
Yeah,
Nothing else is going to return that, and you can't buy a house with $1 million. And chances are, if you can, we are scam. We're not going to hold it. So just buy stock.
yeah. Stop. All right. Depends where.
Well,
Um,
one that's universal for me is growth rate. I think that I like to invest in growing companies. So the growth rate is also
yeah.
across
CAGR.
the compound annual.
Yeah, I'm a revenue guy. I like to look at revenue, and I like to look at what kind of what's happening with the revenues. And if I really like the business, I'll deep dive and look at the margins. I look at net margins, gross margins. I look at the I look
Yeah.
at the balance sheet. I look at the cash balances, and then I'll just start to do my own informal due diligence. So those are the things I would look at.
And that's would be the fundamental analysis, looking at the margins. Yeah, she's just said it. Yeah. If you want to go more technical, some things like support and resistance, what seems to be support and resistance anyway, and so on and so on.
I was waiting for the next question.
Yeah. I think I had someone just DM me some last minute ones on Twitter.
Let's hear that.
Uh, what do you look for when you're investing in a company?
I mean, a lot of what we said before. I look at the management. I look at the capacity of the management. I look at ownership structure, and for me, I look at the possibility of a liquidity event. Meaning, I look at business and I wonder, would somebody want to buy this entity? And then
Mhm.
why?
Mhm.
Because I'm not gonna lie, that red stripe thing really, like I remember I knew Berger was gonna be bought just based on the low debt, whatever. I just never knew the price was gonna be underwhelming because the price is like $10. I remember I bought at 3 and it was like 20.
Mhm.
So I knew it was going to be bought, but I never expected to go up. So I look at buyout capacity. In other words, there's like this line in a song, right? You can want the whole world or the boulevard, right? And I don't even want the boulevard. I like wait for the whole world because I'm not interested in a business that's going to give me 20%. I think I said that before.
Yeah.
So that's why I don't. When you hear me talk about something, chances are I see it exploding in one way or the other. So I look for that explosive capacity, and I'm very patient. So it's kind of like why now, I'm a Alaska holder. I'm not buying anymore, but I'm holding Alaska manufacturing. And I will hold it until the end of time, unless of course something massive happens. Because just how we look at how the economies, the businesses in the space are structured, something is going to happen somewhere. It's just a matter of when.
I remember the actual first day I met Ryan. That very same day, I was up at UE by the law gazebos, reasoning to arm some things out with my friends. And we were going through Key. For one reason or another, we were just looking through Key. And something was really interesting to me was that like losses year over year, to the tune of some tens of millions, some probably like maybe even like 100 million at a time. But they had like over $2 billion in assets, right? So when we're just sitting about it, deliberating, just thinking about it, say, wow, look at this. If somebody can turn around this company, especially in the space that they are in insurance,
Right.
and it's been said a couple of times, like insurance right now is the new banking. I think that's a Randy quote.
That's a grand
You know,
quote.
insurance is the new banking. So when I thought about how competitive the insurance game was getting, I was saying, yo, okay, there was a buyout there was the Advantage General buyout, there was the Guardian buyout, and then lo and behold, sometime later, there was a key buyout. Very bought it for around like 800 million, I don't get the figure on. And then that just exploded in a matter of a couple months. So had I, bought on my thoughts, then I would have been way, way up, way up. But at the time, I was just thinking, and sometimes you just need to trust yourself, trust your thoughts.
No doubt. I mean, that's why I say we're all trying to figure it out along the way. Nobody knows with certainty.
Mm-hmm. Any seasonal stock picks that go up through certain quarters?
I don't know. I can't even speak to that. You guys set that one.
I'm thinking about
Nothing comes to mind. Uh, how did you get into investing?
I realized that the richest person in the world and a lot of equity. So
Yeah.
I just wanted to own stuff. I think people don't take ownership seriously. So I just wanted to own stuff. And I was like, stock market allows me to own things. That's enough for
Yeah.
me. I don't even care that anymore. I mean, it's the weirdest. It's just for me. It's just more of a personality thing. Like if I'm involved in something, I need to own it or own. I need to own something. So like even what I do, I mean, I can't get to that, but
So
even
the
just
only can be free.
I
Yeah.
do Ryan Inc. as a business. So and that's just kind of my approach, and that's kind of what fuels my motivation to work hard. Anything I do, I try to have ownership in it. And I mean, yes, of course, early days when I just started working, I realized that okay, I don't own this private company, but I own my brain, I own my work ethic. If I build a model, I own that. And, you start getting to building blocks here and there, and then you say, oh, you make a little money, oh, you need to buy a little bit of red stripe or a statue or grace candy, whatever the case may be, and just keep building. I said, listen, if I can't own intellectual property, no, rather, if I can't own physical property, I'll own intellectual property. If I grow to be able to own physical property, that's fine, but you can still buy intellectual property. And my thing is, if I can, but listen, imagine if you just had the thoughts 20 years ago to get the trademark filed. Just the word Twitter. You just say, I don't know what Twitter is. Just go and buy the web URL, twitter.com. Or what, or you register the trademark for it. So any idea I have, I buy the URL for it. Because you just don't know. And it's just, and investing is so cheap.
Yeah, it's online real estate.
Yeah, I mean, I mean, that's what I said, you buy all this real estate when you're rich. You don't buy it to get rich, in my view. You know what I mean? You buy it when you're rich and then you're liquid, and then You have cash, you probably have cash now, you can buy any house you see listed now, because a lot of them coming up for sale, you know. People overextend themselves, so you get the liquidity discount. That's why I invest. I want to own stuff.
I My answer is super simple. Like I got into investing when I went on work and travel, made some money, and then by the time I came back, I was like, wait, where all the money gone? So luckily I bought some 200 iPhone cables, and I gradually took the money from that and pay for gas and then use the rest, net profit, and just invest it. Yeah. Oh, okay. What's this one?
Is it fair to expect? Now, this is getting into like
Yeah.
analysis, and I'm sorry, I would literally answer from on vacation, so I can't give you an informed opinion. So I just rather than I think Lumber Depot may have a few things at play. I think could become an acquisition target. I think it could. I gathered the numbers were good. I didn't really look at it, but I kind of been focused on the US this last few weeks. Could they get back? I mean, perhaps, but as I said, if I had it as a local indigenous company, I would be looking to hold it for the time being.
Mm.
Still like Scotia. I still think it has its place. I think though, obviously the price has fallen. I think if one really wants to know what to think about it, look at the multiples. But I still think Scotia is going place. It's a matter of what the place is eventually look like. I mean, they paid well. I don't have any because I think in this same L.E.A.R.N Grow investing, I had disclosed my shift and why I shifted. Though I didn't have to disclose why I did. They paid 45 cents in dividends this last quarter. And that's $1.80. And if you multiply, if you get the yield at 41, it comes out at 4.39%, which is still above what you're getting on a 30-day or 60-day or a 1 year, right? In terms of base rates at BOJ. So BOJ base rate is 0.5%. So as far as Scotia goes, I think commercial banking will have to lead the way in terms of any economic recovery we see in Jamaica. And NCB can't do it alone. And speaking from experience in terms of the two institutions, technically Scotia is a better bank, in my view. I think NCB is the better bank for business, but in terms of core banking competency and execution, it's unpaid endorsement. I think Scotia is a better bank, but they both have the drawbacks.
All right. Oh, I was just about to say that. Mm,
When you say individually, I
you mean like
assume that
investing
means
and
you actually trade
like,
by yourself as opposed to calling a broker and asking them to execute. If that's what you're asking, then it is you pay less commission when you're doing your own through the J Trader platform, from my knowledge at least. But I mean, that would obviously depend on whether or not you will be executing. Um, the there are other factors to consider. Well, there are factors to consider. So that's one, the commissions that you have to be paying, and obviously that would have to also factor in the frequency of trades and executing. So that's what you need to look at.
or if you mean like unit trust, for example, like with Barita's unit trust or the Sigma, which is Sagittarius unit trust, is all a matter of looking at past performance. Hmm. Yeah, you can use past performance as an indication in that sense, if it's consistent enough to say, okay, if they're bringing about X% and the market is bringing about X%, do I feel confident enough in my ability to out earn that unit trust or out earn the market in that sense?
All right. How you view, what's this? How you view, hold on, I have it right here. How you view, where is this? Hold on. That's not the end of it though. Hold on. 15 cents.
Oh, yeah. companies qualitatively and quantitatively.
I think we went over that though, like the metrics.
Yeah.
Yeah, yeah, we went through that, the metrics. The debt ratios and the margins, whatever, whatever.
Debt ratio, cash ratio, PE, things like that.
This is what from Philberg Invest. Phil, I'd love to answer that question, but here's a problem. So, firstly, I know John personally, and I have a lot of respect for him, and I like him a lot. And secondly, that's a very expensive answer, so I won't answer it. Big up John, though, my friend. I like John. Both of them, actually. Have food and just.
Well, here what I can say. One, you should learn the dividend yield ratio. You know, actually think I have it pasted up in my room somewhere. Like I'm that type of person to write it down, paste up a room, and actively keep an eye out for the posts of JC, right? Because, for example, NCB was a big dividend paying stock last year, Scotia was a big dividend paying stock last year, and then what? Situations happen, they're not paying out as often as they would have before, if memory serves. But companies announce dividends all the time. It's not a one single stock that are going to pay the best dividend. It's not always consistent year over year, quarter over quarter, so forth. Like Cygnus is pretty consistent in paying out large dividends. You know, they're known for that. They like to boast about it, and I've benefited greatly from it. So that's cool and all. But then, you know, there could be other companies out there that have a better dividend payout. And once you keep an eye on the X date, record date, payment date, can't go wrong. Especially if you're buying into companies that you yourself like. You think it's really featuring ASML?
Yo, I'm telling you.
What came first, the chicken or the egg? That's man. No, but seriously, no, I genuinely like it. I genuinely like it. I think the value, the multiples are fair. And listen, the reality is the business is 30 plus years old, the owner is 80 plus, and we don't know what the succession is going to be. And I mean, Lasco is probably a 30, 40, 50, 60 million US dollar business. Last M, that is, could be more. Why wouldn't we want to buy it? You know, why wouldn't somebody want to buy it? So they do, last I checked, they do $6.5 billion on milk powder sales a year. I mean, it's milk powder alone. I mean, if they have another product of scope that emerges, we talk. I mean, they're so efficient now and increasing it so over time. $1 billion sales could result in profit going up 300 million, or 200 million. I mean, that's significant. So it's not just. I mean, of course, I used to buy it before, and I had issues with the cash flow, so I sold profitably. And I bought a lot more because I just have this feeling that it's. I mean, listen, let's just go through it. Jamaica has 3 million people. Do you think there are 100,000 people who've never heard Alaska before? That them kind of thing there, and then this massive facility, and it's all. My position was informed by the numbers, so one led to the other. No one could say, is it the chicken or the egg that came first? I'll leave that where it is. How do you advise a young investor at limited resources? Not just buy great businesses. If you're trying to grow quickly, then you probably have to take a bit more risk. I wouldn't advise that you buy 4 banks if you want to grow your money quickly. But try to look at some small businesses, lumber depots, whatever. And I wouldn't say flip IPOs, but I would say try and identify small growing businesses.
I would say
them.
I would say build your confidence as an investor, right? So say you have limited resources, that actually makes it a lot easier for you to enter and exit, right? I can't tell you the amount of times well, not as often, but say for example, let me use a general example. Like the more money I have, is the more difficult it is to enter and exit without issue, right? So, say for example, even with IPOs and the allocations, the more money you're trying to enter in is probably less the what you'll be getting out of it in terms of actual units based on the allocation and whatever, right? But I would say build the confidence as an investor, right? So say for example you have $5,000 in the J trader, try make 10. Like
Definitely.
try 5 10.
All right. So
Like 10 at
I'll,
once.
pre- I'll preface my comments by saying I don't know what you have already. So I view portfolios generally as like building a house. You start with the foundation and then you add thereafter. You don't start with the roof first. However, I accept you may have to do a bit of both at the same time. With that said, I think you have below or your proven barista Jamie Reese.
Okay, so they're fully just okay.
Yeah, I think you'd still want like NCB, Grace Kennedy, and a few other staples, but those six are all decent in to different extents. But I have not read either Alliance or Derriman's prospectus yet. I'm on holidays, man. So forgive me, I don't have an opinion. However, I think if Derriman takes 1 billion, as I said, or 1 point whatever and pays off the debt, then
Oh,
they'll have a lot better cash flow as a result. So instinctively, without reviewing either, I think Derriman has greater upside right now, but I have not looked at either closely enough to make an not guess, but share an informed opinion.
all right. Um, look like you want to say something on this.
Not really. I was just, I mean, that's something that we could talk about.
Yeah.
Everyone has a great answer. That's interesting. I want to talk about that. Anyway, where are they going?
Well, select fund, like we
So
said, is an index fund, right?
one, right?
Huh?
Which select fund?
Um,
Oh, no, probably just general.
all right, well, I'm going to assume select funds, the financial tracker first, and say, remember that the purpose of select funds is to track the financial index, which is NCB and friends. So, yeah, you're watching select, you're really watching NCB, to be honest with you, and to see how they're moving along and yeah, what growth looks like for that. Select manufacturing. I really haven't taken a deep look at that in terms of how they structure how they structured it. Yeah. So for
What do you
example, I remember glancing through one day and noticed that
highest
America
rated?
was that?
What do you mean? As in how it's rated?
Yeah, like for example, the weighting, the particular companies, because to me, Mailpack is a distribution company, but I guess they would say it's logistics or whatever, so it didn't meet the qualifications of being in Select M. So, and it's pretty interesting. So, for example, you don't really have to look into the allocations of what the weightings are, who's the biggest mover, what are the plans for the biggest mover in terms of seeing how these funds are going to be, what the trajectory of these funds would look like. Uh,
Guys asking the fire questions tonight, boy. I mean, listen, let's just go back and dial it back, right? So the tax benefit was designed so allow the business to grow, effectively saving 25%. So effectively, for that to have achieved its end goal or its objective, they would have to have pursued an expansion plan. The benefit of the tax break obviously would have elapsed with the list, without there being the main market. I gather the only difference is there may be increased fees. I would expect it to happen, but I think it's really just down to them. I don't know the rules well enough. An attorney could probably advise, but generally speaking, the benefits would be over the period of over the 10 years, whereby, so, or you see what's the benefit of staying? Well, it may be lower fees. I don't know. I don't actually, I'm not able to speak on that. I think Access could have graduated also. So maybe it's just pride too, right? The next thing though, if they're on the main market, they can take in capital exceeding 500 million. So that would also be, and that's something I know. I can't say how I know, but I learned that through an attorney in something we're looking to do. It actually killed a deal that we were working on, which would have been an incredible deal. So that may be it. They can do the larger APOs, etc. Should they desire, and that seems to be the order of the day. That would be the benefit.
All right. So we're going to take the last three questions, I guess, because we are kind of wrapping up right about now. Right. So, what's the benefit for L.E.A.R.N to stay on the junior markets?
The straightforward answer is that.
Yeah, straightforward answer is the tax break. All right. And lower fees.
It's actually not 500,000. Depends on who you're dealing with, but yeah, we can do it either way. It's cool. Yeah, you could transfer it, no problem at all.
They just pay the fee.
Well, there's no fee for. Oh, sorry.
Yeah, for the for L.E.A.R.N, for Darius and APO, they exceeded their cap raise, cap limits by some degree, I believe.
No, the loophole was CFF because they were more or less saying because they had majority ownership of CFF that were they to go to the main market and CFF shareholders would be negatively impacted. That was in Sunday papers, I think. They had to explain that. Yeah, man, there was a big article on it.
Yeah. Okay.
Caribbean flavors. None.
Like you're grown, bro. You get kicked out like when you reach 18, graduate from you and parents say, yeah man, we're out on your own.
Yeah, pretty much.
Last question, guys. Last question. Who's got the last question for us today?
Who's that for?
You can contact 876 Invest at 876 Invest on Instagram, at 876 Invest 1 on Twitter. If you want to speak to one of us individually, you can message the group, message me on Twitter at Thunders.
All right.
These are the famous guys. I'm just hanging out with them this evening.
Wow.
That's crazy.
Wow. Really no.
Yeah.
All right, but as I said, at 876 Invest 1 on Twitter, at 876 Invest on Instagram. You can DM me directly, but please DM the business page. Right.
5 Solar. 5 SOLAE. Twitter. I think send me an email, Rochelle. G2K president at G2KJA.com. I'll add it. Oh God, I'm gonna get 40 emails. Oh well, so it is.
Such is life, huh?
Yeah, so it go.
Drawbacks of prestige. Who can say why Alliance don't have a share buyback?
I haven't read it, so I can't speak to that.
Robert Shin and what's the other one?
Tito.
There we go. They can say with absolute certainty.
I don't know. 55, that's funny. All right, that's it for me.
All right. Yep. Seems to be. Okay, guys. That seems to be all the pertinent questions for tonight. 1 hour and 20 minutes in. Okay. Once again, I'd really love to thank our guest, Mr. Ryan Strachan, here for today, for facilitating, for reaching out to us, for the, all this knowledge that you really come on and brought forward to us, Great shout out and big thanks to Learn, Grow, and Invest. You can check out their YouTube page. They have a Facebook group. They're on Twitter as well. Once again, we're really grateful for them facilitating us today. And every time we come out, I feel like a better investor every time. Yeah.
Yes, sir. Big up. Big up. Thank you, guys.
Yes, sir. All right, guys. Thanks so much for your time. Thanks for joining us, our wonderful viewers. And we'll be back with more investment forums, meetings, and offerings to bring as much value as we can to you guys. Okay. All right, guys. Thanks so much. Have a good night. Enjoy the holiday season.